evening, everyone, and thank you for coming to Brandeis University's presentation on Athena Health. I am SNMS from Pakistan, and here are my team members.
Varun from India.
Xiaofeng from China.
Zhensu from China.
Athena Health is a healthcare information technology firm which is US-based. It was founded in 1997 and is headquartered in Watertown, Massachusetts. It provides healthcare IT services to hospitals and physician practices. Its product offerings include a billing manager, a patient communication system, and an electronic medical health record platform. They also provide data analytics, which combines all of these three elements and provides great value to its clients. Currently, Athena Health occupies 5% of the US market share. Now, when we submitted our equity report in November, the stock price of Athena Health was trading at $130 per share. At that time, our base case scenario indicated a target price of $162 per share. We felt that Athena Health's acquisition of Hippocrates, their past cross-selling abilities, their growth rate in the enterprise deal market, and the current shift of the industry towards the cloud indicated that Athena Health was a buy, with an upside potential of almost 22%. Now, in the last few months, the market has agreed with our opinion, as the stock has seen an upward trend, and it currently sits at $176 per share. These recent developments have allowed us to reanalyze our estimates, and we are now going with the hold rating, with a target price of $171. Now, Athena's rise to the top has been made possible due to its unique value proposition in its three business segments. Athena Collector is a physician billing and practice management system which accounts for 55% of Athena's revenues. Their second largest business segment is Athena Communicator, which streamlines the communication process between physician and patient. Their third business segment, Athena Clinicals, is a cloud-based electronic health record platform. With a 97% adoption rate, this platform has been voted as best of its kind by the research firm KLAS. Now, the beauty of Athena Health's cloud-based platform is that it eliminates all upfront IT costs for hospitals and physician practices. Now, this value proposition, combined with Athena Health's past cross-selling abilities, has enabled it to grow its physician base at a CAGR of 40% in the last few years. Going forward, we expect these growth rates to continue, as we expect it to grow at a 35% CAGR. This leads us to our first revenue driver, Athena Health's acquisition of the mobile platform Hippocrates. Now, for our analysis, we conducted an online survey of 200 US physicians, asking them about the use of mobile applications for clinical reference. What we found was that 68% of physicians already use such applications, and out of those who don't, 26% intend to do so in the future. What this indicates is a great market opportunity due to the acquisition of Hippocrates. Now, before the acquisition, Athena Health's market share stood at only 5% of US physicians. But with Hippocrates already in the hands of 50% of US physicians, we can expect this market share to increase going forward. This leads us to our second most important revenue driver, Athena Health's cross-selling abilities. Currently, 21% of Athena Health's users use all of its three products, or as Athena likes to put it, a triple barrel sale. History has shown us that Athena Health has steadily increased its triple barrel and double barrel sales, fueled primarily by the Ascension deal in 2013, which added more than 4,000 physicians under the Athena network. Going forward, we project these growth rates to continue and provide more revenues for Athena. I would like to call upon Varun now to talk about the next revenue drivers.
Thank you, Essen. So our third revenue driver is Athena's ability to clinch enterprise deals. Traditionally, Athena has catered to small physician practices, but over the last 3 years, their focus has shifted to the enterprise account segment, where they've seen a growth of 141%. We expect this growth to continue at a conservative rate of 12%. One of the biggest reasons why hospitals would choose Athena Health is a huge IT cost savings of 40%. Our last revenue driver is the shift to the cloud. As much as it's been said, we confirmed this using results of our survey, which states that 85% of our participants prefer to shift from their existing practice management systems over the next 3 years, out of which 64% of them prefer to shift over the next 12 months. Now, the result of our survey stated that more cloud-based users are satisfied with their existing practice management systems than server-based or in-house based users. Looking at the competitive landscape, we mapped Athena against its competitors across various parameters. as much as its competitors are higher in terms of market share and penetration to the enterprise, Athena scores above them in terms of providing a cloud-based platform, mobile solutions, ease of use which is key to physicians, and the ability to scale to the enterprise. This competitive advantage can be seen looking at the revenue growth rates, where its competitors have declined over the last couple of years, and Athena during the same period has increased its revenue growth rates. Now Xiaofeng will be talking about the revenue growth model and financial analysis.
Thank you, everyone. We know that Athena's revenue equals revenue per physician times number of physicians, and these two factors are also market influenced. The Obamacare has increased patient traffic, leading to a higher collection per physician. The entire industry shifting to cloud will lead to more physicians using Athena. Athena's strong ability to land enterprise deals and the acquisition of Epoctis will increase its market share, while its cost-selling activity can largely offset the bargaining power decrease due to industry consolidation. All in, we are bullish on Athena's revenue growth. Looking at the historical financial data, EBIT margin has a significant drop in the past 2 years. This is due to a headcount increase for Athena One project. Athena One project is a major update. They right now focus on ease of use and integration, and the acquisition of Epoctis. Recognizing both these are one-time events, we believe margin and earnings per share will rise going forward. On the balance sheet, Athena do not have any debt until 2013 when they borrowed to acquire Epoctis and Arsenal on the Charles. Arsenal on the Charles is a real estate property. They right now use it for headquarters and R&D center. The debt to equity ratio now is at 55%. With Athena's strong ability to generate free cash flow, we believe the leverage ratio will go down. Doing multiple valuation, we found traditional server-based companies cannot make best comparables to Athena and its cloud-based solutions since they have not matched Athena's recent growth. So we compare Athena to cloud-based firms. Although these firms are in different industry, they are right now in the same development stage as Athena. Giving 18% of weight to cloud-based firms and 20% of weight to the server-based firms, we reach our target price for multiple at 168. In our base case DCF model, we project 10% of Epoctis users will sign up with Athena, leading to a 33% revenue growth CAGR for the next 5 years. And Athena's cross-selling activity can largely offset the projected bargaining power decrease. We also build our bull case and bear case together, get the target price of DCF at 169. Now Sam will talk about simulation and risks.
Thank you, Xiaofeng. We performed the sensitivity analysis to have a dynamic view of the stock price by simulated uncertainty to our revenue forecasts. We did this to overcome the weakness of the DCF model. We measured the size of uncertainty by regression and then simulated 5,000 times revenue scenarios for the next 10 years. Finally, we plugged in our revenue curve into the DCF model to calculate the stock price. 177 is the mean of this distribution, and as you can see, it's very close to the market price. With the DCF weighted at 15%, multiple and simulation each at 25%. Finally, we got our target price at 171. This value, although bullish, still lower than some target price like places like Pepper Jeffrey and Deutsche Bank. To analyze our risks for our investment thesis, we came up with a risk matrix, evaluating the probability and possible impact. As you can see, we don't have a high impact and high probability risks, but a failure to realize the synergy from Epoctis acquisition or failure to increase the demand from cloud technology could have a high impact on Athena. But on the other side, physicians opting for more mobile solution technology in the future and the low cost of implementing cloud technology made this argument unlikely to happen. The 4 strong revenue drivers and good business strategy and good management gave us confidence in holding position at a target price at 171. Thank you. We are open to questions.